and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Ben Lofthouse, manager of the Henderson International Income Trust. Hi Ben.
Morning.
So we're looking at income this week, and it's very important for people to not just stick to the devil that they know. UK equity income is very widely held in the UK, but of course globally there are great companies paying dividends, and your trust is a good complement to a UK equity income trust or open-ended fund because it only looks for companies that have a compelling case for income outside the UK. Having said that, your largest geographical exposure is in the US, where I think quite a lot of people have been saying it's time to get out of. So why are you liking the US so much?
Yeah, it's a good question. I think what we are finding in the US are really good quality companies at attractive valuations. And I think what you've seen since the taper tantrum a few years ago is actually that the income stocks have not been performing well this year. And that's given an opportunity for, and actually money has been coming out of the US market. It's been one of the biggest outflows this year has been from the US market. And that, in my opinion, is offering value in certain areas. So areas like telecommunications, you can buy some things like Verizon, which are cheaper than almost any other telecommunications company in the world at the moment. You can buy things like General Electric, on good valuations with an over 3% yield. I just feel that actually that there are some really good companies there on similar valuations to other companies around the world in certain key areas.
Coming then across the pond to Europe, which is quite some way behind the US in terms of the economic story, but presenting as good opportunities for income investors.
Yeah, Europe's really fascinating at the moment. So Europe has been really struggling to grow ever since the crisis, and some would say before. If you look at the last year, a number of things have happened, one of them being quantitative easing, the currency has fallen, fuel costs have fallen. To me, it feels very much like the US in 2011, and maybe the UK when quantitative easing started. And that environment, what we found was that income delivering stocks were actually quite strong. So what QE did was not particularly drive very strong growth, but more often reflated financial assets. So in areas like Europe, we're finding companies like Zurich Insurance Group, 6% yield. The Swiss long bond is almost zero. There are a lot of companies like that, and I think we will see gradually over time more money flow towards European equities from both Europeans and elsewhere.
So this is like UK equity income a couple of years ago, where we had those bond proxies have done so incredibly well, very steady Eddie companies, high quality, that just chuck off income.
Yes, yeah, I think that's right. And perhaps, again, similar to the UK, the banking system in Europe has taken a lot longer to be recapitalised, and we've just got to a point where lending is picking up. Capital ratios have got to the levels that the regulators have said. There might be more capital required, but we are seeing lending picking up. And again, that's been an interesting point in the other markets around the world over the last 5 years. It's been a good time to invest.
So jumping around the globe, you have an international mandate, which means you can go into emerging markets, but you're choosing not to that much, are you? Why is that?
Yeah, I think there are two factors in that consideration. One, a large part of the emerging market investable universe is linked to commodities. And we've seen a very strong period of growth for a decade in commodities. And I feel we're just seeing the start of the slowdown. So, I don't know how long it lasts, but I think what we've seen in places like Europe, in the UK, is sometimes it takes longer for the full consequences of that to become clear. And the second part is linked to that. Actually, we're not finding a lot of what I would say interesting, high-quality companies that aren't commodity-based or finance-based in those markets that are cheap. And so I think people can see the issues with emerging markets. Those people who kind of are practitioners there have bought the high-quality stocks. I'm just not finding the opportunities yet in the kind of stocks that we like to buy with high barriers to entry, high free cash flow, and particularly not necessarily reliant on commodities or finance.
Ben, thank you very much.
Thank you very much.
This is Emma Wall from Morningstar. Thank you for watching.